Hey everybody, welcome back to our next episode of For Starters. Today we wanted to talk a little bit about the changing face of what startups should be thinking about in terms of expenditure and controlling their costs. For years and years and over the decades in the innovation economy, there have been discussions of various things. You may remember the lean startup methodology and other ways to control costs. And then, of course, as the cycle turns, people get really exuberant again, and there's a push to grow at all costs. And so you get the situation that we experienced a few years ago, and again in the early 2010s, where companies were extremely overvalued, and those valuations were based on just growth numbers or even user numbers that were not relative to some of the more fundamental economic questions around unit economics and how a product was actually making money for the shareholders and for the company. That has certainly changed, and I suspect, I think maybe this time is a little bit different. I think that the nature of the pullback in the last 3 years in M&A around the space that we have discussed many times on this channel is maybe relative to the fact that the exits, the strategic buyers, the financial buyers, and the public markets have kind of unified their view on this, which is that they want to buy companies that will make them money and that are valuable in various ways. Now, there are always edge cases and exceptions, and there are certain areas of the market. We are seeing it, of course, in certain kinds of AI companies, although I'll reemphasize what I've said before, which is it isn't just tagging every company that has AI or a .ai website with around. But there are certainly edge cases, and there are companies that do take off for various reasons. Normally, when that happens, you can ask a few more questions and understand why. Maybe it's a founder who has a bunch of prior exits, or maybe it's a particular characteristic of the backers of the company that allowed them to think about that company in less than economic terms. But for the majority of startups, we have to think differently about unit economics and about how to be more lean in building the company. And I think that has certain implications. So when we advise our startups, we think a little bit about the effect of when we are going to hire certain people and thinking about commensurately keeping the org chart in step with where the company is. So for example, in the pre-seed period through the seed round, we tend to see companies with their personnel be much more focused on the product, the original technology, and solving the problem. Between the successful seed round and just after the Series A, we start to see more emphasis on the sales and revenue operations. I would actually say that extends between seed and even just before the Series B. So there it's, okay, we have a product and a technology, the solution should work. Are people going to buy it? Can we break into certain markets? And so you'll see some hiring on the revenue and commercial side. And then after the B, you start to see introduced into the company's org chart operations and finance. Oftentimes that is when we start to see companies that have, a CFO or a CEO really early, and that starts to concern us. So there's really kind of a right time in general to hire certain people. It's also really important to these days be leaning more on board and experts. And I would say maybe an overemphasis on specifically the people around the company that are helping with finance, keeping better track of where the money's going, why you're spending, querying and pushing vendors to be less expensive, negotiating payment terms. These are things that are not as relevant when money is freer and liquidity is all over the place, and is much, much more important at times like these, where you really do need to make the dollar last because it's harder to raise and it's really expensive when you do raise. So the idea of the board, certain experts, outsourced and insourced finance professionals, maybe even spending a little more than you would normally think on specifically the finance function, so that you actually, again, can stretch that dollar. I think that's a really important thing. And last but not least, and I think this is the absolute, the key component of the era that we're living in, is unit economics. And we talk to our portfolio companies about this all the time. When you are thinking now about decisions relative to your product and your customers, you really, really want profitable revenue, or revenue that could easily be profitable. So you want to be very, very careful to sign on a customer that's underwater, that'll be an anvil just to get more users or to get more logos, because those things can actually destroy the company. And investors these days more than ever are saying, hey, it's not just the dollar, is that dollar ever going to be valuable dollar? Or are we just burning money here to grow in a situation? So, the era of companies that are making $6 million in revenue, but bleeding $34 million a year in cost, that's really, really hard to finance these days. And I think companies are realizing that. And then I do think, one last thing is to think about the cap table and fundraising more flexibly. So for example, structuring around raises, making sure those raises are maybe structured more carefully around milestones or around certain things that make them less expensive to the cap table and align the interest of the investor and the founders and the staff. And also maybe using things like credit and other options that are less expensive to the cap table at a time where each incremental raise is much more expensive than it used to be. The average round used to be somewhere between 15 and 20% of the cap table. Now it's closer to between 20 and 30% of the cap table. So that incremental dollar is really expensive to the founder. And so ultimately, what does this mean? It means the face of the economics of startups are changing. I think it means that there's going to be longer between rounds, which has implications also for fund performance. And it's going to be that companies are staying private for longer. Again, none of this is rocket science. People have been writing about this for the last few years, but I think it's really important. And the last implication is we are seeing now more kind of in the out years professionalization of management. So where the founder is saying, hey, I've done my thing with the innovation part of this. I can now hire a CEO or a president and CEO or whatever that has a lot of experience commercializing and selling a company like this. I'll go and do my next entrepreneurship trick before the exit. And so that kind of team professionalization in the later years to allow the companies to stay private for longer, but not tie up the entrepreneurial talent is something that we're seeing more and more often. So these are things to keep in mind as we see the changing face of the innovation economy in America today.